Okay, this is really, really frustrating for me right now. I just made went through a video. I thought it was okay, even, and then I have this my computer went on a blink, so I have this old computer, and that ran out of the batteries, and then I started at 4 in the morning because I got jet lag in Malaysia, and who cares? You don't give a crap about that. I'm making a video about a financial model for hydrogen. Okay, I have made other videos about hydrogen, but this one is putting things together in a practical thing, using a practical context, using a financial model, putting it really together, put some real data. So here's what I'm going to start doing. I'm going to start talking about a little bit of background, really just how we size the hydrogen capacity, and how the cost of energy from natural gas and electricity should be evaluated, which is the enormous issue. Now, when I make a financial model, I'm going to argue that computing a levelized cost of the hydrogen is a fantastic way to start and understand the model, and then you just put it in a big financial model, and then you put in all the degradation of the increase in the hydrogen, and you put in the stack replacement if you need one, and then you put in all the capacity factors, then you put in the kind of true costs, and you better make an hourly analysis to understand this, and then we'll talk about the structure of the model and whether we can add ammonia and put the whole ammonia cost in and work through some equations in the model. So that's what we're going to do. Okay. Now I have to tell you right now that when I talked to a few years ago, maybe not even that many years ago, people would start to talk about hydrogen. Is it real? Is it not? Now you talk to people and they say, it's too costly. The economics don't work. That's what I'm hearing now. I want to challenge that a little. I want to challenge all of this crap. And the way this financial model came about is I received a model from a big four accounting company. I can say that because it's one of the four, and it was nice colors, all nice. What a shit model that was. They did not have anything about what the cost of the electrolyzer. To figure out the capacity factor of the project, you had to make this big effort to distinguish what's the ammonia cost and the synthesizer cost versus the electrolyzer cost was all so difficult, but it was beautiful. Oh, the colors and all that, it looked good. Okay, they didn't even compute the degradation or the really work through the project, and then the equity IRRs, mixed all the financing and operation, didn't have anything about stack replacement, and the treatment of inflation was bizarre. Now, this case study, I'm going to use a case study, and I'm going to talk about some people, and I hope I don't mention any names. I'm going to try not to. My friend in Egypt, he called me, Eddie, and then, oh no, he doesn't do this. His wife, doctor, calls, he doesn't say that it's his wife, it's like his fancy assistant, calls, oh, we need a financial model. Oh, this is going to be great. This is going to be great. We don't talk about money or anything else. And then he bugs it. When's the financial model ready? When is it ready? So the idea is to make ammonia, and this graph shows ammonia. We're going to make ammonia, and we're going to make it in Egypt using the solar power in Egypt, and then transport it up to Europe. And a lot of people seem to be talking about this very issue. Okay, it seems that there's a cost of ammonia. Now, the big deal here, I want to emphasize, there it is, and all of ammonia is made with SMRs, steam methane reactors. It's made with dirty gray hydrogen. And you can see that by kind of comparing the cost. Now, I can't get this wonderful website that I show you in another video. I'm not going to go through the mechanics of downloading data and all that, but you can, if you look at, you can get the price of urea from the World World Bank. I can't. They don't give me the price of ammonia. I don't know why. Whatever. But you can get that, and you can see a very, very high correlation with natural gas prices. When I make a model, I rather than I'd like to put a picture. There's a solar project in the desert. What kind of levelized cost can we get? This is a little bit aggressive, a lot aggressive maybe. We put that electricity into an electrolyzer. We get some nitrogen in this thing called an air separation unit. You might have a little storage in the middle. And then we put all that together in a synthesizer. And if we could do piece by piece by piece, you can really show what's going on. Of course, what we're going to do now is really focus on this. This is an unrealistic number because this. Okay, whatever. Here's the way I look at this. Now, my friend, he is kind of okay. He's great. Whatever. There was this, what was this thing called? Tech or something like that, where they were going to take put solar panels all over the Sahara Desert, and there's so much sunlight, and the sunlight is there in the European wintertime and summertime. They were going to take that, and this says if every drop of sunshine, blah blah blah, you get 7,000 times the needs of Europe. So we were going to take that solar power and put it up to Europe. It didn't work. I don't know why it didn't work. Whatever. The transmission must have been an enormous issue. I talked to somebody in Saudi Arabia. They were going to build a transmission line up through Syria or something like that. I don't think that seems to be a little difficult. Now, what's interesting to me is that in Europe, they still produce hydrogen from natural gas. And why can't we take this Sahara Desert, make hydrogen, and then transport the hydrogen up there? And then we don't have to and if you're making ammonia anyway, this is not this thing. When I started this thing, I said, let's look at cars and hydrogen planes, hydrogen trains, hydrogen trucks, hydrogen garbage trucks, all that stuff. Now I'm saying, no, let's do ammonia. That's the starting point because we need ammonia. Ammonia is it's a gigantic deal. This man named Bosch in the 20th century, they changed the world. A gigantic change in the world that allows food to be developed all over the world was done by creating ammonia. Okay, that's using this SMR, steam methane process. So we are going to make whatever we call it, the Google Earth. Okay, I said, okay, we're going to make it here with my friend. We're going to make this to Abu Kir, whatever. And we're going to take our hydrogen, here's the different things, and we're going to shoot it up here with a boat. Because right now, a whole lot of ammonia is transferred by boat anyway. And then my friend said, we need to make hydrogen at 1.5 US$ per kilogram. And they said, okay, we're going to get electricity from solar power at 2 cents. Okay? If and our electrolyzer is going to have an efficiency where we take the kilowatt hours divided by the kilograms. We're going to talk about that a lot down here. So if we have this 52 multiplied by this 0.02, you get an energy cost of hydrogen of about 1.5. What that means is if my friend wants this kind of crazy target, and the question is this a reasonable target or not, which we'll get into in just a minute. Notice that I'm supposedly talking about financial modeling, but the real issue is understanding the economics of what you're doing before you get into this financial model. This 1.5 minus this 0.45. 0.45 has to cover all the capex, all of the degradation problems, all the opex, everything else. Can we do it? And do we even care? Is this target even right? So my friend, he said, I've got this Chinese producer who's going to do it. It's kind of cool. The first question I say is, what's the real target? That target, I think, is BS. And I think if you're still producing electric power in hydrogen, still producing hydrogen in Europe, with what's happened to the gas prices, the real cost to beat, the real opportunity cost, I don't give a crap what the regulated price of natural gas is in Egypt. Almost irrelevant. Why in the hell would people in Egypt who have real problems get, if they subsidize the cost of natural gas, why would you take that artificially low cost of natural gas? You could sell it to Europe, and I'm arguing the price to Europe is maybe somewhere around 13 USD per MMBTU. If you could sell it at that, and you're only selling it at whatever, $7, whatever they said the regulated price is, which is completely irrelevant in Egypt because there's not enough natural gas. They didn't find all this gas that they were supposed to get from the Mediterranean wasn't there. It's okay, enough. Opportunity cost is that's what we should really do. Now, we're going to do some analysis with our financial modeling and our levelized cost, which is going to go into the financial model. I'll show you 1.5 is not realistic, but maybe 1.8 could maybe okay. I'll show you why. That seems like a radical kind of proposition. If you want to make this price competitive with natural gas, even at 8.5, it's really difficult unless you consider some emission costs. Now, when we consider emission costs, the interesting thing to me is that you could use the kind of basic cost of CO2, the CO2 that shoots out into the atmosphere when we do our gray hydrogen, but you could also account for the fact that when you get natural gas out of the ground, there's going to be some leakage, and the cost of that leakage is enormous. And I want to work through, and this could be relevant for the financial model, could maybe not, but the true economics. And I'm not going through all this crap about no, Europe has this special subsidy scheme where you put it in and you get it back at night, and you measure the cost, the marginal cost of electricity. Blah, blah, blah. Let's look at the pure, true cost, okay? So we're going to account for emissions, and the real driver here is this dramatic cost, the capital cost. And let's look at that for a minute. But before we look at that, to give you a context, and this is so goddamn important in the whole world, let me do something right now, and let me pause. Okay, now I've been working on this file too much, and it's just a file that downloads the data from the World Bank called a pink data sheet. And you go to, there's another video I just made on this, I don't have to go through all that. All right, and just to give you a context, we hear all this stuff about, the economy and politics, and I'm not going to get in trouble here, My mother was Swiss, and I really have this European kind of little attitude or whatever. Here, let's look at natural gas in Europe. No, natural gas in Japan compared to crude oil. So I've got those two things. And I went back to 1960, I think. Or maybe I can't, just a minute. Oh, good. That was so interesting. I just did this in nominal terms, and it kind of looks funny. I don't know. Whatever. But, sorry. We got to put this in real terms, and, oh, man, just a second. I'm just going to look at the price of oil, not the price of natural gas. Now, if you look at the price of oil in nominal terms, here was the shock. It looks like this little kind of thing, and then the 79 shock, and then the low price in the 80s, and then the 2008 shock. the increase and the decrease. And then if you put this and adjust this for real data, and that's, I have a whole little thing that gets the price indexes and all that. This thing was such a change in the world. And I've said this many times, and this thing was even bigger. This shock to the world. My God, I got my first car, I think, around here. And right here, the gas price was nothing. Oh, that was nothing. We could drive everything for free. The world was so different back then. Make America great, blah, 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 blah. This changed the world so dramatically. People started talking about nuclear plants, blah, 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 blah. Okay? Oof, well, they were not talking about it before. But that was such a dramatic change in the world. Now, when we now let's look at natural gas instead, and to get let's compare the Japanese or Asian natural gas with maybe we don't have to go all the way back. Okay, and again, I love to go through all this crap with that little drop down boxes and everything else, but let's go a little bit back here. 1996, and you can see the very tight correlation between natural gas and oil. And then if you look at this, and let's now compare Japan natural gas with U.S. natural gas. I'm sorry if I've done this before, and I'm kind of repeating a little bit. And there you can see, and now what we got to do is put this on the same scale. And you can see the dramatic change in the shale gas here, which brought the U.S. out of the 2008 recession, the Great Recession. It really did. And the U.S. economy is doing so great, blah, blah, blah. So much of this is the cheap energy. It went up here. And now if we compare this with European natural gas, again, all in real terms, then you see this. And this is what I want to talk about. And it's not this Ukraine stuff. And that change in the world is kind of like that oil price shock. And that's really what we're talking about now. Now, if I go all the way up here and just look at the last little bit of time, let's look at it maybe up to here. Here, no, that's too far back. And then let's go after the oil price shock. Now, I should stay there for a minute, because right here, notice that the European and the U.S. natural gas price was almost the same. And then it's this now, but it's affected, of course, by this stupid little, this horrible little thing. Okay, so let's go kind of to after they've resolved a little bit of this problem with we got to go a little bit further. Okay. A little bit further, I'm keeping going, sorry. One or two more, there we'll go, okay. And there's our kind of differential in natural gas prices. Europe, the last time I downloaded this, $13 US per MMBTU, US $4. US was down here at below 2, oh my God. Okay, that's driving the world right now. All this crap, tariffs, blah, 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 blah. Move industry, blah, blah, blah. Oh, how this enormous, this is so sad. My mother was Swiss. Oh my God, I still I'm crying for Europe. I really am. So if we're going to make hydrogen in Germany, we're going to still use that. We're going to have to buy that really high natural gas. And, so where did I put that? That's showing that there's still a lot of SMR capacity for making ammonia in Europe. All right. Now, so for me, that's the overriding concern. Now, the second thing is the cost of the electrolyzer. And I put 910 and I meant to put 900. And we've got to understand how to interpret these costs a little bit. That's the, so here's a little bit of background for the analysis. When I started doing an analysis of hydrogen, oh my God, I just got I didn't know that 33 kilogram, 33 kilowatt hours is equal to 1 kilogram. I did not know that. And that's an energy value, which is just a different way of stating the amount of hydrogen. You can measure hydrogen in kilograms. You can take that kilograms and measure the same energy value you get in kilowatt hours. Now you can do the same thing with BTU in kilowatt hours. That's what this number engineers always look at it, and then we can convert it to MMBTUs, and we get this. And then we can take the MMBTUs and multiply it by 33 and get this famous number for the energy value of hydrogen in terms of MMBTUs in kilowatt hours. And the reason we do that is because the price of electricity that we put into the hydrogen is going to be measured in kilowatt hours. For green, for electrolyzers, and for MMBTUs, it's going to be measured in, for SMRs, it's going to be this. And we can do the same kind of thing with kilograms to tons. For ammonia, I have to think about this. I thought, okay, hydrogen weighs less than ammonia because nitrogen weighs more than hydrogen, I think, because it's got more electrons and protons and all that stuff. So this number is less than 1 if we measure the kilograms in 1 ton or whatever kilogram of nitrogen of ammonia. Okay, and then I love this thing from the IEA. Okay, whoops, I got a message from them. Really, oh, they call me prof. How do I get rid of that? Oh, no, okay. And then she must be awake at 6 in the morning here. Right? That's okay. I started this. I'm in my other video at 4 in the morning. Oh, shit, my head is hurting. This thing shows the efficiency. If we have 64% efficiency, we take 33 divided by 64 and we get 52. Or we can look at a bad old gray hydrogen, and that's 76% efficiency, and that's a big deal. 33 divided by 76, the number would be 43 instead of 33. We still lose something. And then here's the big deal. When they compute the cost, the capital cost, here they take 900. Oh, I'm supposed to be doing this. Here we take a 900, but that's KWE. That's KWE. KWH is KWE is in this case for green hydrogen is 32. So we could measure this 900, which is based on this, or if we would have a smaller denominator and spend the same amount but get measured on the basis of H2, which is done over here, we get an effective cost of 1,400 compared to the cost of gray hydrogen, which is this, compared to the cost of blue hydrogen, which is adjusted for this efficiency. But that's only the first step. Okay. The next step, and this is the real problem with green hydrogen, and when people say it's not economic, it's a crazy thing to do, we don't have to go through all the details of the financial model. What we need to do is understand, we need to understand that if I'm looking at my shoes, well, I'm not looking at my shoes really, but sometimes I do. My shoes are old. I try to buy one pair of shoes every couple of years, whatever. Okay, and I think about a shoe factory. And I think about one shoe factory that can operate all the time that you need it. You can't really operate 100%, maybe 95% because you need a holiday to go on vacation. Well, that's a scheduled maintenance, so we can never get 100%. But with gray hydrogen, you can get the gas whenever you want. With green hydrogen, we're limited, and I put a 30% capacity factor in here to demonstrate this, and we're going to go crazy talking about the capacity factor before we get into the details of the financial model. And that's the big problem. So this number, which is now adjusted, if we realize we have to take this number and spread it, we can only produce 30% here versus 90% in the other one. The effective cost is enormous. If we use this 900, the 900 came from, oops, oh, come on, the 900 came from this one, okay? So now let's get into some, for modeling, let's begin with sizing of this thing. And again, this horrible thing from this big four coming, it was just shit. I had to sign some NDA or something, but I'm not telling you where it is, and they never paid me anyway for the little project. So what the hell? And that Egypt guy obviously doesn't pay me. And here's what his proposal is: we have 850, but that we want to produce 170 kilograms. Now, when we want to produce 170 kilograms, the question, come on, is how much capacity do we need to get this 170? Okay, per day. And then we can put per year or per hour. Now, you got to be careful when you convert hour to day, because if we take 850 and we take our efficiency thing and we divide it, because it's megawatts instead of kilowatts, we divide it by 1,000, then you can get this number in megawatts that will produce a megawatt. We need more megawatts than kilowatts. And this is megawatts, not kilowatts. So we get whatever. This is 8,000 with a 000 for kilowatts. We get this much hydrogen every hour if it's operating at 100%. But we're never operating 100%. Now, this crazy proposal, they claimed you could get 45% capacity factor, which, God damn it, is bullshit. So when we go to a day, we multiply this by 24, but we also got to multiply it by the 43%. Now, if we need that per day, that 170 per day, we can get the 170. This is if it's 100%. So we got to take this one, multiply it by 43%, and then we get the 170, and that's how we can work through the whole sizing of the business. And that's a big deal, and it drove me crazy at first. It's not that hard. But here's what we have to do. And then when we I'm going to open the sheet in a minute. This is the levelized cost of hydrogen sheet. And if we're comparing SMR to electrolyzer, we've got to adjust and realize that you need different amounts of capacity to start with because of the different efficiency if we want to make the same kind of target. Now, notice I didn't add, because we have a completely different capacity factor. This time we get a lot different production for the SMR, and we'll divide it by the amount of production and that's what we're doing with levelized cost analysis. Okay, and then now when we make our financial model, we can put a solar and wind project, solar plus wind. We could put some battery, which would be the most idiotic thing to do in the world, I think, unless the battery costs come really low. Okay, it's so much cheaper storing hydrogen once you've got it made than storing electricity, lithium battery or something. So we have our capacity factor, and we can get our production. I don't know why I kind of showed you that. Maybe because this capacity factor is a really big deal. Now I put a much higher one for wind. We'll talk about that in a little while. The question will be: would you rather have a higher capacity factor and a higher cost, and spread the electricity over a bigger denominator? Spread the capital cost over a bigger denominator. So let's just talk about this. Now, this is another thing I got from a wonderful person, Gunas. She gave me this kind of proposal for building a hydrogen project in Oman. This thing drives me nuts. Here's the capacity of the electrolyzer, two different scenarios. And then they take this 310 and so we're going to build wind capacity and solar capacity. And when we do that, we're going to get, where's the number of hours? We're going to get this many hours per year. So you take this hours, 760, everybody should know is 365 times 24. It doesn't include the leap year, and we get a 66% capacity factor. But to get a 66% capacity factor, we have to oversize the solar, oversize the PV. And what happens if you have 1 hour when you're producing solar at 100%, maybe not quite 100% you can get. So let's say 300, 320 or something you can get. And then at the same hour, you're producing the 310 of this, so we take 6, let's just pretend you can get 100% on both, so you could take 55. Ooh, did I add that up right? I think I did. Oh my gosh. And if you got 655, you only need 250. What are you going to do with that extra power? You're going to stick it in a battery and kill the economics? You're going to sell it off grid when you have too much power anyway and put some kind of merchant price? What are you going to do? This just screws it up so badly, and that's what I want to talk about. In this case, we have a 57% capacity factor. This is some other model. Again, how'd you get that? Now, to do this, and here's my big idea about this, is that if you go and say, I'm going to run to my financial model, I'm going to put an input C and an input S sheet in my financial model, I'm going to make it have such beautiful colors you can hardly stand it. Oh, and my friend, that's what I think my friend in Egypt, who we've never met, but Eddie, when's the financial model done? Eddie, when's the financial model? He calls me Eddie. That's fine, other people do. If you don't start with hour by hour, go to hell, really. You gotta start by understanding. So here's PVGIS, where you can get hour by hour. And here's Egypt and Libya. Who cares if you Sudan, wherever you're going to project, Saudi Arabia, whatever, or anywhere around here, you're going to have a really low cost of solar power. You're going to use bifacial to increase the yield because you can get the reflection of the sand. Maybe you're going to be like some other people, put tin foil below the sand or something like that. We're going to get a good capacity factor on solar, and more important, this is just getting it here. We're going, but the problem was the heat, of course, on the panels. But it gives you a pretty stable a month-by-month thing. If this was Norway, oh my gosh, we'd have nothing in the winter. Germany, a lot less in the winter, more in the summer. Maybe Spain would be okay, but we're going to get this kind of flat capacity. That was this idea of this DesTech thing in the first place. And then we're going to look at wind. And we can go to the Global Wind Atlas and see that there's a lot of wind right by the Red Sea over here. And then I found another study that shows the different kind of, you can hardly see this, what's the wind speed at different places. Oh my gosh, can't we just put the wind together with the solar, and then we'll have this remarkable project? No. Okay, here's some more wind. I even went to Google Earth and find some wind turbines by the Red Sea over here. Must be pretty windy over here, and then put them up at 100 meters or something like that and make our adjustments. And then this is this hour by hour thing from the PVGIS. And we get some hours, STC 1,000. That means we're producing at 100% capacity factor if we had no performance ratio. If we had 80% performance ratio, we're producing less than 100. This is how much we could produce, and this is the degrees of the sunlight, this is the temperature, and then they give us the wind at 10 meters per second. I don't know how good this data is in Egypt, because it's not consistent really with this Global Wind Atlas, which has been criticizing what's the best method. God knows. Okay, but we take the wind and we adjust it for the height of the turbine, 10 meters or something else, and we get a capacity factor here, hour by hour by hour, okay, and then I put a little losses in and get a kind of 90% performance equivalent kind of ratio for the wake effect and all that stuff. And then we get hour by hour by hour. Now, we go up here and we say, okay, this idea, this silly idea that the wind is going to be produced when it's dark outside. And then if you do this, oh my gosh, we could get a high capacity factor because we're producing solar in the day, the wind in the night, and we just need 250. And then we'll get a really high capacity factor, and we won't have this big problem of spreading that shoe factory problem. I gotta come up with a better example here. So here's wind and solar, but by looking at hour by hour, oh shit! Now this is what we don't want. We don't want wind when the solar is, the blue one's solar, the red one's wind, and we make a graph with lookup and do all our fancy little things. We do not want the wind and the solar to be together. You want this non-coincident. You want them to be non-coincident. So here's a different June versus October, whatever. Solar is always kind of consistent. I don't know what this little dip is in the middle that you get from PBGIS, but who cares? Okay, and I express this in terms of capacity factor. And then we can put the capacity times the capacity factor. So in this one, I'm just saying, okay, here's our capacity factor. Let's put 345 of wind, 345 of solar, 310. Let's see how much electricity we get. These are simplistic kind of things, but it demonstrates the point. Here's our electrolyzer, and we get a lot more. Oh shit. No, we don't in this one. Oh, this one we don't get enough in this day. But we'll look at every hour, and then when we look at hours, there are going to be some hours. I put this one back. Some hours we get way too much. What are we going to do with all that extra shit? Electricity, good, renewable electricity. Shouldn't have said that. Okay, and there's our little graph, and we make a nice little graph, and then we understand what in the hell is going on. If you don't understand this, don't leave it. Don't make your beautiful colors where you don't even put the cost of the electrolyzer in your analysis. Okay, good. Then sell it to somebody and say, I'm a big four, so I'm gonna sell you this for a lot of money. Here's over time. You can look at this, just beautiful. You can look at the capacity factor of the winds going up and down in this case. Solar really flat. What should we really use? And so what this is back to our wonderful proposal in our kind of case study. Here's the cost of the electrolyzer. $239 per kW. Oh my God. Oh, we are going to be able to do this. But then they say, oh, we got to add some installation costs and some other stuff, so it's going to cost $287. This is not my data; it's there. We're going to get an efficiency of 52, pretty good, because that is equivalent to 63%. We're going to have O&M cost at about 3% of the capex, which is just nothing. Okay, and so it's really, other than the energy costs, the O&M cost is kind of not a big deal. And so let's now move to the cost of energy. Again, this is all before we make our financial model, and I'm going back to a wonderful little IEA table, which changed everything when I just have to work through this. It's just an example of how to put things together. So here we have our 64%, 76%. We're going to compute the cost of the different things. This is an old thing. I start with 33. We put the whatever these efficiencies in, and then we get the efficiency in terms of the MMBTU per kg, and this is the electricity. We take this one, multiply. In this case, I put 2.5, and we got the cost of energy here. If the cost of gas is only $4, we're nowhere close. But remember, they're making ammonia in Europe. And they're paying these really high costs of natural gas. If this thing is much higher, then the energy cost situation is really different. Now, when you work through this, I never can get this consistency, because they said that when they first gave me this little proposal, it said 4,000 cubic meters per hour, okay? And then we compare that to the 200. We have to take these meters cubed, convert them to kilograms, and when I do that, I got a different efficiency. So God knows what's going on. I would question this, try to make these little computations to understand what's really happening here. Okay. Now, what am I doing here? I gotta remember. Shit, coffee. Oh God, I'm sorry. It's instant coffee. Okay. I got the applied efficiency. This is our target. And then here's what they did. They said, here's the cost. They gave us these numbers. We could, in our financial model, we could put make a separate model for solar, a separate model for wind. They said wind is going to cost 3.5 cents. 1.8 cents, but by the time they put it in the model, they had these 2.5 cents because they had the energy cost of here. So what I said is they must be assuming some transmission cost and some grid stability cost. Now, when you do that, you got to be really, really careful. And then they said, here's the weighted cost, and we're going to get this higher capacity factor of 43%, which is complete bullshit because, you know, you're going to have to oversize the thing and sell the extra capacity. And by the time I was finished with this, I said, screw it. This whole mixture business I thought was, oh, this is the answer. This is the answer. But when you do hour by hour, it's not. So you add some cost. Now, this could be a little bit of grid stability. We might need to put a cheap little battery in here that just operates for 15 minutes or so to make sure that our energy doesn't fluctuate way too much, okay, for solar power, okay? Maybe, maybe not. We have to look really carefully at our solar pattern, hour by hour, minute by minute kind of fluctuations. And then we'll go into natural gas. This is from my other thing. This is what urea is. Here's the cost of urea compared to the natural gas index that the World Bank gives you, and you can see this correlation. It's all natural gas. Here's the Asia cost versus the urea cost. Here's the US cost, and that's this dramatically lower cost, but the scales are all messed up. So I just want to tell you something about risks of, let's say you build an electrolyzer, and the cost of urea goes up and down, and it's really fluctuating. Well, if you buy natural gas for your project, when you buy natural gas for your project, the margin you make if you're an investor is this minus that, or whichever way it goes. Yes, the red one minus the blue one, whatever. We'd have to put them in the same units, blah, blah, blah. But there's a natural hedge. When the natural gas price goes up, then the ammonia price goes up or urea price goes up. When the natural gas goes down, then the price, the costs go down. You've got a natural hedge. If you're building, you're poor shit. If we're building green hydrogen, we don't have this natural hedge, and we either get a really high number or a much lower number. High or low, we take the risk of natural gas. How bizarre is that? If you're selling, it's just like electricity. If you're selling, and that's just how markets work, I'm sorry. If you're trying to produce green hydrogen, you have a bigger risk of natural gas than if you're producing SMRs, okay? And then, you know what we really have to do in all of this, and it just drives me nuts, and I've made so many videos on this, I can't even talk about this. This is real LCOE. Google real LCOE, and it comes up with real love. Did you type real love wrong? No, real LCOE. We need to adjust for the fact that this is a level cost, which is the same today as it is in 20 years. What a bunch of shit! Especially for a capital-intensive solar project, we should adjust for the inflation. We can have a lower cost here and then get a higher cost in the future. Okay? So I'm going to do everything in real terms and allow the inflation. I'm going to put that in the model too. You can argue about that. But if you're evaluating the cost and doing all that target price of hydrogen business, you better do it like this. Whatever. That kind of came out wrong. So when we put all of our kind of data together, in this case, what did I use? In this case, I didn't even show what I used. Solar plus wind. Which one did I use? We take the electrolyzer. I used just the solar cost. We get 1.056. If we use $8, notice I made a little spinner box in here. You can argue with me about spinner boxes. Then our cost of our electrolyzer is less than this. If you include some emission cost, and that wonderful IEA said, how much CO2 do we have per kg, but I put it in tons so we can multiply by like a 50 USD cost of ton, then we get this kind of cost difference. Oh, we're on our way. So if this is the energy cost, the real question is, you're not going to build a new electrolyzer. Can you take this cost and beat this number? That's for me the real test, okay? And what did I do here? Oh, now I just changed the price of natural gas with the little spinner box, and now we have a big margin to go on. And if you include the emissions, which I didn't really include all the emissions because I didn't include the cost of leakage of natural gas here. Isn't this more interesting, really, than getting into the financial model with input C, input S, blah, 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 blah. Okay, and then the next question is, what if we put the wind? Well, if we put the wind in, just a minute, what do I have here? This is now the capital recovery. I'm moving to the cost, the capital recovery per kilowatt hour. And what I do per kilogram, we take the cost of capital, we adjust it for inflation, we put how many years we're going to run this thing, and we get the capex spread over the amount of kilograms. If we and then I put a little flag here for solar or not solar. With solar, we've got a lower capacity factor, so we have to recover more capacity cost per kilogram. If we have a 40% capacity, 45% capacity factor, this is lower. So the energy cost from wind might be higher, but overall, maybe we can make it work with wind. Doesn't really work like that. We'll see. Okay. And then I have to talk about solar degradation and electrolyzer degradation. Solar degradation, that goes down like my brain's going down over time. Hydrogen degradation is as if, it doesn't happen to me, as if I need to eat more each year to keep myself going. So it's an input versus an output. Just a little note on there. And then let's look at our CapEx a little bit more. Now, this is again this proposal. They put a 650 CapEx per KW versus 1,000 CapEx per KW. But then I got an article from my friend Asnan in Malaysia. He said, look at this article. This is an old article too. 200. Oh my gosh. Okay. And then here's our proposal. Oh, look at this beautiful electrolyzer. They got a picture. Or no, that's when they're building it, and we got a cost of this. 47 million for 200 megawatts, 239 per megawatt. And they said there's no real economies of scale. You just put more little containers in. Oh shit! I got the alarm is going on. Okay. Okay, let's continue. I might have to interrupt myself a little bit again. Okay, so this is the quote we got, and they even say that for competitive, this is the amount you pay for a proton membrane, and this is alkaline. I don't know what the WE is. 300. If these are the costs, that changes everything. Our capital costs can be spread. That's the difference between now. We use 287 and we're competitive, and we don't have to have this horrible problem because it's all magnified by the capacity factor. Okay, so now I'm what am I talking about now? Now I'm talking about some O&M assumptions. I threw some O&M assumptions in here, and then we get our total levelized cost. Now, I'm going to put this file, and I'm not premising, I'm going to call it Egypt LCOE, and I'll put associated with the video or something, I'll put that. I think what happened here is my website came back up. Thank you. And the day is becoming better. And then I'm going to go over here and put hydrogen analysis. And in the overview of hydrogen, right there on that page, it says edit PowerPoint slides. I'll put these PowerPoint slides there, and then some Excel files, and this is the financial model, and I'll do the LCOE, so you can kind of work through all of that. Okay, and here we go. Okay, and so once we adjust for inflation, once we put that dramatic low cost in, Okay, here's the O&M per kilowatt. And then we have this stack life problem. This used to drive me completely crazy. And here's this comparison from this investment bank of the stack life for a alkaline versus PEM. I can say PEM, proton, membrane, electron, membrane. Sorry. Oh, you can see how little I really know. If you have an 85,000 stack life, I used to get obsessed. Oh, now that means alkaline is better. And by the way, alkaline costs less. Alkaline has a better efficiency. Is that right? No, this is the efficiency down here. Maybe PEM has a little bit better efficiency. But if you can consider the cost and the stack life and what other kind of things. The other problem is can you really operate this one? Does it bounce around? I know all that crap. Okay, whatever. All right. The point I want to make is about this stack life. As soon as you see 8,500 hours, you say, okay, let's divide that by 8,760. Just pretend the 8,760 was 8,500. And that would give you 10 years of stack life. So you'd have to replace the stack every 10 years if you're operating a 100% capacity factor. If we're operating at 30% capacity factor, we're not going to have to replace the stack, and the life of the stack might be a lot more than anything else. So stop, like me, stop worrying about this shit. Even for 45,000, if the capacity factor is, let's say, 30%, that life is going to be you're going to be able to operate for a long time. And this is what they say the stack life is. They put even more hours of the stack life, and then it's just not very important. And I went into this financial model and put this little table in where we figure out how much of the hours have you run, and then you see how many remaining hours you have. And when the remaining hours fall to zero, you got to stop and make a stack replacement. You got to pull your project out of service for a while, and you put that all in your financial model. And I'm very proud of all that. But let's just look at things first. Degradation is the next thing. And the question is how much degradation you actually have. This one's at 2.3, this one's at 1.35. What's the degradation? The degradation is very different and it poses some problems. That's a pretty big degradation, by the way. Even 1.35 over 20 years, that's a lot. And that means we have to buy more and more and more electricity. And we better make our transmission systems big enough to capture all that extra electricity. That may be a bigger issue, and we better model all that. And we can put that in a levelized cost analysis. Here, I put a levelized cost analysis in, a kind of more comprehensive one. And here's one where I include the effect of the degradation and all of this. And in this case, an electrolyzer, in this case, with a low capital cost and a low cost of solar is pretty good. But then if the cost of natural gas is 8, we can't beat the cost of natural gas. I should really do this. And that's all levelized cost. And do that levelized cost before you start making your financial model, and do a careful levelized cost. I remember somebody in France, this wonderful lady said, well, I'm going to make a model. I'm going to make a model. Why are we talking about all this levelized cost business so much? I try to say, I know you're going to have to make a model and put refinancing in and put all the fancy stuff in. But start with understanding what the economics are. That's what we're really doing. And I've got it. This is kind of embarrassing. So now if you put a much higher capital cost in, then the whole thing starts falling apart. And this is the high cost of capital. That's a really big issue too that I spout on and on about. If you want, I remember this guy who came from some gray hydrogen said he had to make a 15% project return, or 20%. Crazy number, absolutely crazy number. That's ridiculous. Okay, and then we can go to this emissions analysis. And I just showed you this thing where this 0.089 comes from the IEA, but then we can try to here include the cost of the leakage. And when I do this, it's really, you got to be careful. Oh, I didn't put another thing in here. I'll put that in later. And now I'm just going to talk about the financial modeling. When you make a financial modeling, set up a nice little input C case. I put a conditional formatting on what we're on. I put a little conditional formatting on when we change this assumption so we can put on all these cases. We got the same sort of inputs we were just talking about. Put those in and start with the production, and then once you have the production, go to the CapEx, and once you have the CapEx, go to the OpEx. These are all just the assumptions, and then you can run a little case. You can make a little thing and run a goal seek to say, okay, you go to the financial model, say we need to earn a 7% return. Here's the kind of numbers. It's very similar at the end of the day to the LCOE, maybe not exactly. And then you can do the sensitivity analysis. This is with the financial model and see what kind of cost you get with different variants. That's why you make a financial model. And then, so really what I'm trying to say is go and open that financial model, and there's a page called the operating model for the electrolyzer, and you put in all the capacity, you put in all your generic macros, put in all the kind of time little flags and all the rest of the financial modeling stuff. I don't have to go through it all. And then you can, over here, that's the stack replacement. How many opening hours do you start with? How many hours have you accumulated in the stack? No, how many hours? And then you put a subtotal, and you see when you're going to have to replace it. And you put in all the degradation. Not a big deal. It's just kind of regular stuff. And then you can put in the CapEx for the stack replacement if you're running into a stack replacement problem. And then you can put in all your CapEx with an S-curve and all that stuff. They're very standard kind of modeling now. And then I would make a separate page for the project model, because you might have to put the solar, and that example I gave you has a solar plus the wind plus the other one plus the electrolyzer. If you have to put a battery in, you're out of luck. What a waste of time. And then you can put the cash flow and the taxes and got some other shit there. Okay? And that's it, because I got to go to breakfast and get a real cup of coffee. Okay, so I'm going to stop this.